Hi, everybody. This is Bill Witt with Senior Resource Center. And today we have a very important topic, 8 strategies to help retirees reduce taxes and preserve assets. This is part one of a two-part presentation on the tax issues that we all face. At Senior Resource Center, we've created SRC University, and this is our program for providing free education on retirement issues. The sessions run about 30 minutes. They're available on a recorded basis, so you can listen to them at your own schedule whenever it's convenient. And they explain topics in our book, More Money for Retirement. Our goal in providing this education is to help you create a safe, secure retirement plan. And the good news, we have no final exam. So how does Senior Resource Center fit in? How do we help people with retirement issues? We offer comprehensive retirement planning, making sure that our clients don't outlive their money. We do tax planning, not tax prep, to help you pay less tax, and that's going to be the focus of today's presentation. We do a lot of long-term care planning since it's a major issue that most of us are going to face as we age. And we also do estate and legacy planning, helping people pass assets to the next generation securely without going through the probate process. So what's the challenge that we face with taxes? You know, the old saying, there's death and taxes, two things we can't avoid. Well, the United States has probably one of the most complicated tax systems in the world, and the rules that govern our tax system are constantly changing. So having a plan to pay less tax is important to supporting a safe, secure retirement. This chart shows the complexity that we face. I mean, most of us know about income tax, maybe sales tax on purchases that we make, maybe property tax on property that we own. But this shows the array of taxes that kind of literally fit into almost all aspects of our lives. When we're buying products, when we're investing, when we're using products, we're literally inundated with taxes that increase what we have to pay out of pocket. So the solution to the tax challenge is first understanding all the taxes that we pay, and then beginning to make informed choices to reduce your tax obligation. Because every dollar that we get to keep is a dollar that you can either save or spend on something else. So before we dig into this, I want to just touch very quickly, bring everybody up to speed, how federal income tax works in this country. For many people, this is obvious. For some people, it isn't. But we have various tax brackets that apply to the income that we earn, either as a single person or as a married couple. And you can see on this chart that for a single person, the first $11,925 that they report as taxable income, it's taxed at the very low 10% tax rate. From that point up to $48,475, we're taxed, if you're single, you're taxed at a 12% tax rate. And what you can see is we have these different brackets. So the more income that we report, the higher the tax bracket. And the important thing to know here is the higher tax bracket only applies to the income above the lower threshold. So in the case of a single person, if you report income, taxable income over 48,000, that income would fall into the 22% bracket, and only the dollars that are in that amount above 48,475 would be taxed at 22%. Now, our system also offers standard deductions. And if you look down at the bottom of this page, you see that individuals have a $15,000 standard deduction. Couples have $30,000. Then there's an additional bump up if you're over 65. So a single person over 65 actually has 17,000 of standard deductions. A married couple where both are over 65, they have 33,200 of standard deductions. So it's important to understand how this works because, you know, you look at the rising tax rates, and if you can stay in the lower 10 or 12% brackets, you can save money. So we work with our clients to show them ways to stay out of the higher tax brackets. And really, if you sum it up at the bottom, if you add the ceiling for the 12% bracket for a married couple, that's 96,950. Add that to the 33,200 of standard deductions, and what that says is a couple could report $130,150 of total in taxable income and still remain in that low 12% tax bracket. Now, earlier this year, we heard about this big, beautiful bill that was passed, and it actually adds to the standard deductions that are available. My chart doesn't show that. For single people, you can pick up to an additional $6,000 of standard deduction. For married couples, it's up to $12,000. And there's a phase out. If your income is above a certain threshold, they start to take part of that away. But this is just bring everybody on the up to a common level of understanding. How does income tax work in this country? So we want to focus on strategies to reduce the taxes that we pay. And there's 8 of these, and we're going to cover 4 of them today and 4 of them next week. We're going to talk about how to create tax-free Social Security income. We're going to talk about ways to eliminate the Medicare IRMA taxes. We're going to look at CDs and mutual funds and see if there's more tax-efficient alternatives to these 2 investment vehicles. And then next week, we'll touch on the other 4 options. One is how to multiply the value of money that you have to spend in retirement. That's live better on less money. We'll show you how to do that. We'll spend quite a bit of time on Roth conversions because Roth IRAs offer some substantial tax advantages, and we want to show our clients how to take advantage of that. When it comes to homes, there are a number of strategies to tap home equity, and we'll talk about some tax-efficient ways to do that. And finally, next week, we'll wrap it up by talking about ways to pay for probably the biggest risk we all face, which is long-term care, how to pay for it with tax-free dollars. So let's start out. Our first topic is how to reduce taxes on Social Security. And the first thing you need to know is that when President Roosevelt created the Social Security benefit back in the 1930s, that income was tax-free. But in the 1980s, President Reagan, seeing that Social Security was underfunded, he signed legislation that allowed up to 50% of our Social Security benefit to be taxable at whatever tax bracket we're in. Well, President Clinton upped that to 85%. And so today, many people are finding that up to 85% of their Social Security benefits that they thought would be tax-free are now subject to taxes. And how do they calculate this? Well, they need to determine what your total income is. So they take your adjusted gross income, what you get from pensions, from taxable interest, from capital gains. They add up all of your adjusted gross income plus 1/2 of your Social Security benefit plus any tax-exempt interest that you have. And that gives you the total income. And then they apply a chart. And the chart says, if you're married, filing jointly, and that number is under 32,000, none of your Social Security is subject to tax. If the number's between 32,000 and 44,000 for a married couple, up to 50% of your Social Security could be subject to taxation. And then if your income goes above that, over 44,000, up to 85% is subject to Social Security is subject to tax. And the same numbers, there's numbers for single people. There the threshold starts at 25,000, from 25 up to 34,000, 50% is taxable, and over 34,000 up to 85% is taxable. What's significant, many things in our tax code are change on an annual basis based on inflation. But these number limits of 32,000 and 44,000 for a married couple, they haven't changed in 20 years. These numbers don't increase. So it's important to see if there's ways that we can adjust our total income in order to keep our Social Security either not taxed, or taxed only lightly. So what are some of the strategies? I said that the tax on Social Security is based on our total income. So here's 7 different strategies that we talk to our clients about. The first one is to minimize taxable interest. If you have a CD, a lot of people will talk about CDs more later, but CDs are very popular, but they generate taxable interest. And so one of the ways to reduce income that's subject to, that causes your Social Security to be taxable, is to substitute taxable investments for tax deferred investments. And there are products out there where you earn on an annual basis, but you don't have to report taxes. And if you can reduce your taxable income, guess what? We may end up reducing or eliminating tax on Social Security. Another major one, and we're going to spend a lot of time on this next week, talking about Roth accounts. But income that you take out, whatever you take out from a Roth account, whatever it earns, is tax-free, which means you can be receiving substantial income from a Roth account and it doesn't cause your Social Security income to be taxed. And so next week, we're going to talk about strategies for converting tax efficiently, converting IRA, 401k, 403b accounts into Roth accounts, where whatever they grow into in the future doesn't affect your Social Security income. The third strategy is pretty straightforward: delay Social Security benefits. Because 2 things happen when you delay Social Security benefits. They grow, and we've done webinars just on how to maximize your lifetime payment from Social Security. Every year that you delay claiming Social Security, the benefit grows 8%. So if your full retirement age is, let's say, 67, and you wait till age 70 to claim Social Security, you're going to start out with a benefit that's 24%, 3 times 8, 24% higher. Well, not only do you get more Social Security income over your lifetime by delaying benefits, but you also reduce taxes on that Social Security benefit. A fourth strategy involves capital gains. Many people invest in investments and they hold them for a period of time, and then they sell the investment, and that investment generates short or long-term capital gains. Well, one way to avoid those capital gains adding to the total income that affects Social Security is to do what's known as tax harvesting. And that's where you sell investments that are down and sell investments that are up, and the 2 investments cancel each other out, and it doesn't create income that impacts taxing on your Social Security income. The 5th strategy is one that's very popular for people that are philanthropic, people that like to donate to charities. Well, we'll talk next week a little bit about what happens when you turn 73. If you have an IRA or a 401k and you turn 73, the government says it's time to start taking required minimum distributions. Some people don't need the money, but they're still forced to take money out of their IRA or their 401k. And this causes income, and it generates income, and that income causes their Social Security to be taxed. So what is a qualified charitable distribution? It's where someone can contribute up to $100,000 per year of IRA or 401k funds. The funds have to go directly from your IRA or 401k to a recognized charity, and it's called a qualified charitable distribution, or a QCD. Those funds benefit the charity. They get the full amount of the deduction, but it eliminates that RMD income that can be causing your Social Security income to fall into a tax bracket. So we help our clients investigate and do sensible, qualified charitable distributions to reduce taxes on their Social Security. The next one is something I mentioned earlier. The big, beautiful bill that was signed earlier by Congress created a new deduction, a new standard deduction called a senior deduction, and it affects taxes in years 2025 through 2028. And there's a phase out of this benefit. And we work with our clients to make sure that they don't lose this standard deduction by generating additional income that would cause the deduction to be wiped out. The last option is coordinating IRA withdrawals. We mentioned earlier that we have tax brackets in this country, and tax planning allows you to look at the tax code, the tax brackets, and decide how much to take out of an IRA or a 401k to stay in a low tax bracket. So just know this, there are 7 different strategies for adjusting your total income, and it can lead to reducing taxes on your Social Security. Now, I said we don't do tax preparation, but within our practice, we have a number of very interesting tools that we use to help our clients understand the impact of different tax strategies. Remember earlier I mentioned, what if you eliminate taxes, taxable interest? Well, how would that affect your bottom line taxes? And here's an example. This is from 2024. This was a couple that had 2 sources of Social Security income, $42,000 for one spouse, $18,000 for the other, or $60,000 in total. Now, in addition to that, this couple had $20,000 of pension income. They had $14,000 of distributions from 401ks or IRAs, and they reported $6,000 of taxable interest. So that's $60,000 of Social Security and another $40,000 of other income. In other words, this couple is earning $100,000 a year that's being reported. Well, our software that's very easy to use, we can answer questions very quickly, shows that in this case, only $28,100 of the Social Security is subject to taxation. Once again, if you have questions on how you might reduce taxes on your Social Security, bring in your last tax return. We can plug in the numbers and then go, what if instead we did this or that? What if instead of having taxable interest, we put those funds into a tax-deferred product where it doesn't impact? And what's kind of nice, this couple earns $100,000 a year. Look at the bottom of the page. What's the amount of tax due? Only $3,832 on $100,000 of gross income. That's a pretty good deal, and there's ways to make it even better. There's ways we could reduce tax on Social Security even further. So if you have questions, come in. This is a free tool that we make available. We show our clients how to use it, and it's something within a matter of a few minutes, you can see the impact of your tax decisions on what you're going to pay bottom line to Uncle Sam. Every dollar we get to keep, dollar we get to spend on something else. What's the second topic we want to talk about today? Well, it's Medicare IRMA. IRMA's not a sweet old lady. IRMA is the income-related monthly adjustment to premiums that we pay for different parts of Medicare. There's 4 different parts of Medicare, parts A, B, C, and D. And I'll show you a chart in a second that shows you how these different pieces fit together. But realize that people that are in higher income brackets pay the IRMA surcharge or a higher premium, and they don't call it a tax, but guess what? It's a tax. So let's take a look. We do webinars on Medicare, and one of the things we learned early on is let's keep Medicare simple. So we created this simple chart. If you're over 65, you probably get that big thick book that I get, Medicare and You, and nobody reads it. Well, we created a 1-page chart that shows all of your Medicare options. On the left side is original Medicare, and that starts at the bottom with 2 building blocks that come from the government, parts A and B. A is your hospital coverage. Part B is your doctor and lab. A is free. Part B has a monthly premium. And both of these parts have co-pays and deductibles where you have to pay out of pocket. So many people add on the box that's on top of it, what's called a Medicare supplement or Medigap policy. The Medicare supplement or Medigap pays what parts A and B don't pay. And then a fourth box on top of that is Part D, which is prescription drug coverage. That was added back in 2006. That's original Medicare. Many people are on the left side of the page. On the right side, we have Part C, which are Medicare Advantage plans. These are fully privatized versions of what you see on the left. You still have to have Medicare Parts A and B from the government, but then if you select a Medicare Advantage plan, all of your coverage, all of your bills are paid through a private insurance company. But you'll notice that I have three of the boxes blocked in yellow. The Part D up on top, the Part B, which is your doctor and lab, and the Part C. Why do I have these marked in yellow? Because these are the three that are affected by IRMA. And here's where IRMA comes in. IRMA says that individuals that make less than $106,000, if they make less than 106, they pay the lowest amounts. They pay $185 for Medicare Part B, and they pay no surcharge on their prescription drug coverage. But what if my income as an individual is above 106? Well, then I move into one of the higher categories, and you'll see how much additional I'm paying. Instead of 185, now my premium is 259 or 370 or 480. It goes up the more I make. And where this really is kind of insidious is that unlike our tax brackets, remember I showed you earlier, there's a 10%, a 12%, and then a 22% tax bracket. If your income is a few dollars into the 22% bracket, you only pay 22% tax on the few dollars that are in that bracket. But here's where it gets messy. If you look at these numbers, if you report income as an individual of 106,001, you're in the higher bracket. You're paying $259 every month for the whole year. So a few dollars of money that puts you into one of these higher brackets causes you to pay higher. And if you're married, both spouses are paying that higher Part B premium, and they're getting a surcharge added on to their Part D, their prescription drug coverage. Wow, that's a lot of money. If you're up in the 370 or the 480 bracket, that's a lot of additional money you're paying to Uncle Sam just because you have more income. So how do we get out of one of those higher categories? Well, first, let's talk about how the IRMA is calculated. IRMA is based on income, not this year, but 2 years prior. So if we go back to that previous chart, it said that those income bands apply to income you earned in 2023, not 2025. So maybe things have changed since 2023. What if you retired? So your income has dropped. What if you've cut back on work going from full-time to part-time? What if you got divorced? What if one spouse passed away? There are a number of life-changing events that occur, and it's important that your IRMA be calculated based on what you're earning today, not what you earned back 2 years ago, maybe when you were working in a much higher tax bracket. And the way to report a life-changing event is using Form SSA 44. You send this in to the Social Security office and say, hey, I was a big hitter 2 years ago in 2023. Now I'm not making as much. You can report it, and they will adjust your IRMA so you're not overpaying. But what if you're in still one of those brackets? How do we get into a lower bracket? Well, let's go back to the basic strategies. You've got taxable interest that's putting you up there. Investigate tax-deferred products. We show our clients how to position assets into a tax-deferred product that grows, so you still earn money. You're just not having to report it on your taxes. Another category we've already talked about, withdraw from Roth accounts, because whatever you take out of a Roth account is tax-free. It doesn't force your income into one of these IRMA higher brackets. You could delay Social Security income, because delaying Social Security, once again, doesn't cause your IRMA to be taxed. And finally, qualified charitable distributions, those using money coming out of your IRAs that you were going to pay in required minimum distributions that causes your income to go up into an IRMA tax bracket, you can avoid by donating the funds directly to a tax qualified charity. So the third category, we've talked about CDs a little bit. Let's talk about what is a CD? Well, a certificate of deposit is a very popular safe growth option that has minimal market risk. And what is a CD? You go to a bank or a credit union, you set it up, and it pays a declared rate of interest, 3%, 4%, 5%. So you know in advance how much you're going to be earning on your funds. And CDs are issued for specific periods of time, usually from 3 months up to 5 years. You might go to a CD or to a credit union or bank and say, I want a 1-year CD. What's your rate? Funds in a CD are guaranteed by the government. There's 2 different agencies that protect our funds that are in CDs. The FDIC, the Federal Deposit Insurance Corporation, protects money that's in banks, and the NCUA protects funds that are in credit unions. And both are protected up to $250,000 per named account. This is important. We don't have very many bank failures, but if I have $250,000 in the bank and a bank closes, I don't want to lose my money. And so with FDIC and NCUA insurance, I know that my money is safe from a bank going insolvent. But what's the downside to a CD? Well, every January, I get a 1099, and it causes me to have to report taxes on what my CDs have earned, even if I didn't withdraw funds. That kind of feels bad. I didn't get the money, I didn't spend the money, but I got to give a chunk of it to Uncle Sam. And here's an example. Let's say you have a CD that earns a nice 4% interest rate, and you're in the 12% federal tax bracket. Well, you're really not getting 4%. You're getting 3.52% after having to pay taxes to Uncle Sam. So what's the alternative? Well, the alternative is seek out a tax deferred product, one that earns 4%, but where you get to keep the 4%. So how does a taxable investment compare to a tax deferred investment? Here's a simple chart. Let's say we have 250,000 of funds, and I can put them into a CD, or one example of a tax deferred product is an annuity. What this chart shows, both products are earning 5%, and I assume that we're in the 20% tax rate. And so if you look on the left side, you show that the CD first year, that 250 earned 12,500, but I had to give 2,500 in tax to Uncle Sam. So at the end of the year, my bucket's really only got 260 in it. On the right side, I'm looking at same investment, 250. It earns the 12,500, but because it's growing tax deferred, I get to keep all 262,500. Well, over time, the money that I'm paying in interest is actually allowed to compound. If I'm in a tax deferred product, it's allowed to compound and grow. And what you end up with is more money. And this, what my chart shows over a 10-year period, where I assume with the annuity in the 10th year, we're going to take all the money out and pay the tax, still paying the 20% tax, but it's earned additional income. So tax deferred products allow you to grow your money in a faster way. Tax deferral equals higher end value, but the most important factor is you control and get to decide when you want to pay tax. With the CD, the 1099 shows up whether you want it or not. With a tax deferred product, you can decide, hey, it's time to take some money out and I'll pay the tax, or hey, I think I'll delay it, allow the money to stay in and compound and grow, and I don't pay the tax. Well, the end result is it can end up reducing the taxes we have to pay on our Social Security income, and it could well reduce your Medicare income and reduce the IRMA surcharge or taxes that you have to pay. Now, one other advantage to certain types of investments, I mentioned annuity as an example of a tax deferred product. If you have money sitting in the bank and you have a unfortunate car accident or a creditor, a lawsuit, and you see these ads on TV for the guy who's on top of it or the name you know, the firm you trust. These are attorney firms that are representing people filing lawsuits. And unfortunately, funds in a bank are protected from a bank closing, but they're not protected from creditors and lawsuits. So you can work hard and have money growing safely in a bank, and then an unfortunate incident can create a creditor lawsuit situation where you can lose the money you have in the bank. Well, one of the advantages of annuities, not only are they growing tax deferred, but they come with protection from creditors and lawsuits, which means you have money in the annuity, you get sued, just like your home and like your IRAs and 401ks, which are protected from creditors and lawsuits in Texas. So are after-tax funds that you hold in a tax-deferred annuity. As we get older, our eyesight and our reflexes slow down. It's very important to protect the assets we've worked so hard for. The fourth topic I want to talk about is mutual funds. These are very popular investment options. Many people have in mutual funds. So what is a mutual fund? Well, it's a collection of stocks or bonds that reflect a specific industry. It might be the automotive industry. It might be high tech or the electronics industry, or it might be a geographic area. It might be stocks in the United States or stocks in a particular country or international. Or it might be based on the size of the company. Small cap, little companies with small capital investments, or big companies. And so mutual funds are ways of diversifying your investments and spreading it out over different types of categories of investment. But what's the downside to mutual funds? These are things that pop up that sometimes are very frustrating. Mutual funds, when they buy and sell assets in the fund, they can generate capital gains. Some of the investments might generate dividends. Well, capital gains and dividends are passed on to the shareholders. If you own mutual funds, your mutual fund generated capital gains, even if you don't take money out, even if you roll the money over and say, I just want to reinvest whatever I earned, you have to report taxes. So this can be frustrating. You didn't take any money out, but yet you've got to give a chunk to Uncle Sam. Kind of like going back to our CD example, where I roll over the interest in another CD the next year, didn't take any out, but I have to report and pay taxes. And where it gets even uglier, you can have what's called a phantom gain. This occurs where early in the year, the fund sells some investments, so it reports capital gains, but before the end of the year, the value of the mutual fund went down. So your investment actually lost money, and yet you got to report taxes. Very, very frustrating. Another thing that many people don't realize, people worry about paying fees to have their money managed. And with mutual funds, oftentimes the management fees are hidden. They're actually embedded into the mutual fund, and they affect the earnings. They actually offset or reduce the earnings that you receive. And finally, mutual funds, because they're invested directly in the market, obviously they can go up when the market's going up, but they can also go down. So what's a good alternative? Well, here's an example. There's products called tax-deferred equity indexed annuities. What are these? Well, these are products where you invest money and it tracks market performance. If the market is up, you clock a gain in your tax-deferred annuity. But if the market drops, you don't participate. And so some way to summarize that, you get some of the upside, but none of the downside. These are very popular for people that are conservative and that have experienced major market corrections and don't want to see their hard-earned money go down again. Tax-deferred annuities are offered by insurance companies, and they're offered for specific periods of time, typically 1 to 10 years. During that time period, while you're invested, they have liquidity. Typically, the liquidity starts at 10% after the first year. Some have higher liquidity. If you take out more than 10% in any contract year, then there's usually surrender charges that decline over time for excess withdrawals. The advantage of the annuity is it's growing tax deferred. You decide when you want to pay Uncle Sam. So we've talked about 4 different strategies. Tax-free Social Security income. By adjusting your total income, you can reduce or eliminate taxes on Social Security. Obviously, we want to reduce or eliminate Medicare IRMA taxes. That's money just going out because you were lucky enough to earn more income. And then you may want to investigate alternatives for CDs and mutual funds. We help our clients do this and then program their choices into that spreadsheet I showed you earlier to show the tax impact on their overall income and on Social Security. Next week, we're going to touch on 4 more very important topics. We want to talk about how to multiply the value of your money with products that allow you to live better on literally less income. We're going to talk about Roth IRAs in detail, 2 different strategies for converting 401k IRA money to Roth. We're going to talk about tapping home equity tax-free. That's always nice words to put when you're taking money out of home equity. And finally, most of us may experience a long-term care event. We're going to talk about multiple ways to pay for long-term with tax-free dollars. So make sure you tune in next week for part 2. And so as a wrap up, 8 strategies to help retirees. If you have questions about ways to pay less tax, please give us a call. Our numbers are up there. Our consultations are always free. We look forward to answering your questions and helping you create a safe, secure retirement.